This video will help you understand and take advantage of your incentive stock options before they expire. If you don't know who I am, my name is Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. In today's video, I thought we'd cover incentive stock options, specifically what are incentive stock options, how do they work, and how are they taxed, as well as a brief explanation on the alternative minimum tax, and then some best practices to be aware of if you do have incentive stock options. So let's jump in. Number one, what are incentive stock options? Incentive stock options are a form of equity compensation your company might give you that fall under the broader category of employee stock options. There's two types of employee stock options. There's qualified and non-qualified employee stock options. The qualified kind are called incentive stock options, and incentive stock options have the ability to achieve some pretty unique tax benefits if you follow all the rules. Those rules are specifically provisioned in the Internal Revenue Code section 422, which means this favorable tax treatment is not afforded to any other type of option other than incentive stock options. Unfortunately, if you don't follow the rules outlined in section 422, when you sell the stock, it will be considered a disqualifying disposition, and it'll have the same tax consequences as a non-qualified stock option. Those tax ramifications we'll cover in another video. In general, stock options allow you to purchase a particular stock for a set price in the future. Of course, you'd only do that when the share price is higher than whatever the cost is for you to execute that option. The difference between the fair market value of the stock when you decide to exercise and the amount of money you paid to exercise that option is considered the bargain element. You could also think of that as your profit. There's three specific dates to be aware of when you're thinking about your incentive stock options. That's the grant date, it's the exercise date, and then the sale date. On the grant date, that's when you're told about the stock options you are to receive, and you get a bunch of details on them. Number one, when will they vest? Because oftentimes there's a vesting period before you can actually do anything with these options. Number two, it'll tell you what your strike price or exercise price is. That's the price that you will have to pay if you want to convert this option into a share of the stock. The good news is there's no tax liability on the date that the options are granted to you. For a quick example, let's assume that it's January 1 of 2023 and you've been granted 10 options of company stock and the strike price or the exercise price is $50 per option. That means at some point in the future, if you want to turn these options into stocks, you'll need to come up with $50 for every option you want to exercise. Let's say you've met all the vesting requirements, which to keep it simple, let's say this vesting requirement is 3 years. You were granted stock options on January 1st, 2023. You've waited your 3 years, so now it's January 1st of 2026. You don't have to do anything at this point, but to keep it simple, this is the first time you'd actually be able to do anything with the stock, and you doing something is called exercising the stock. That's why this is called the exercise date. It's the date you choose to exercise your option. By law, you must exercise your option within 10 years from the date of grant. That's outlined in IRS section 422. That's not something you can control. If you wait that 10-year period and you don't exercise your option in time, the option expires completely worthless, which might be a smart move to let the option expire if the stock's trading at a level below the strike price. But most of the time, let's just assume that the stock price is higher than the strike price. So now at the exercise date, let's say you decide to exercise all your stock options, and so you pay $50 per share to exercise all 10 options. And let's say each share was actually trading at $80. So let's say you bought the stock for $50 and the stock's worth $80. So you made $30 per share. 30 bucks times 10 shares is 300 bucks in profit. So you profited $300 on this exercise. Under the typical accounting for your taxable income, this bargain element or this profit you made, the $300, is not considered taxable. However, unique to incentive stock options, this profit is considered a tax preference item that will apply to the alternative minimum tax calculation. If you don't know what I'm talking about, that's totally fine. Most people don't, but we will need to know a little bit about the alternative minimum tax if we want to be smart about using our ISOs. And so we'll cover alternative minimum tax later on in the video. But under normal circumstances, this profit or bargain element is not considered a taxable event. The third date that's super important is the sale date. That's when you voluntarily decide to sell your stock. For the purposes of this example, let's say when you sell the stock, you made a profit. But there's a chance you might not have actually profited when you go to sell the stock based on what you paid for it. This is where the true value of incentive stock options shine, because there's a way that you can have the difference between the sale price and the exercise price that you paid be entirely treated as long-term capital gains. This is unique to incentive stock options, and the way that you make this happen is you wait at least 1 year from the date that you exercise the options, and you wait at least 2 years from the date that the incentive stock options were granted to you. This is called a qualifying disposition, and it makes the entire benefit of this option that you exercised and then sold considered long-term capital gains. For most people, that long-term capital gain is going to be taxed at 15%. For some folks that are making a higher income, that long-term capital gains rate could be 20%. For some folks that aren't making as much in income, that long-term capital gains rate could be 0. However, in all circumstances, long-term capital gains rates is going to be less than your federal income tax bracket. In this example, let's say it's January 2nd of 2027 and the share price is worth $100 per share. You exercise 10 shares for $50 and now you're selling those 10 shares for $100, which means the difference between 150, which is 50, is all treated as long-term capital gains. On the other hand, if you don't wait long enough, you will have committed a disqualifying disposition, which isn't the end of the world. There's just pros and cons to each strategy. But a disqualifying disposition is when you sell the stock and it hasn't been held for at least 1 year since exercise, or it hasn't been held for at least 2 years since the date of grant. If that's the case, all disqualifying dispositions treat the difference between the fair market value at exercise and your exercise price, which is that bargain element. That's going to be considered ordinary income when you finally sell the stock. And then the difference between the fair market value at exercise and the fair market value at sale, that's going to be considered capital gain. And it's going to be considered short-term capital gain if you held the stock for less than a year since the date of exercise. And it's going to be considered long-term capital gain if you held the stock for more than a year. Now we're going to start getting into the alternative minimum tax. To keep it simple, if you exercise your option and then you sell your stock in the same calendar year, you don't have to worry about the alternative minimum tax. However, if you're planning on exercising the stock in 1 year and then selling it in a future year or never, you will want to be aware of the alternative minimum tax. So let's jump into the alternative minimum tax. The US tax code uses 2 accounting methods to figure out how much you get to pay them in federal income taxes. There's the normal tax accounting method that we're all familiar with here, and there's the alternative minimum tax that most of us are not familiar with here. Both of these calculations are being done every year to determine which one is higher. Whichever one's higher, you get to pay to the IRS. Most people don't end up paying the higher alternative minimum tax rates because they just don't end up on that schedule and they end up paying more in regular tax rates. So it goes relatively unheard of. However, if you have incentive stock options, there's going to be a line item in your stock plan that says be aware of the alternative minimum tax. Before, when I mentioned the bargain element, which again was the difference between the fair market value at exercise and the price you paid to exercise, that difference or profit, that bargain element is considered a tax preference item for the purposes of calculating the alternative minimum tax. All you need to know is that bargain element gets added to the calculation to determine if you are going to pay alternative minimum tax or if you're not. And for those of you thinking ahead, yes, this does mean that you might owe taxes via the alternative minimum tax on money you made, but you never actually took home. This is called phantom income. You can't see it, you can't touch it, but it's there. And according to the IRS, you get to pay taxes on it. And along the lines of phantom income, if you try to hide this income from the IRS, they will find you because your investment custodian sends them a form 3921 that says, here's how much you exercised this year in incentive stock options. So unlike a phantom, you can't hide from the IRS. The good news is, even though exercising options is a tax preference item, there's a chance that your alternative minimum tax still might be lower than your regular accounting method. And if that's the case, you won't have to worry about the alternative minimum tax. But if you end up paying more in alternative minimum tax than you would have otherwise, the difference between those two, you're going to want to track. That's the amount of tax liability that's specifically due to the alternative minimum tax. And when you go to sell your previously exercised options that are now stocks, you can recuperate the alternative minimum tax that you paid extra in previous years. This is called the AMT tax credit, where essentially the IRS says, hey, you paid more in this year as a result of the bargain element, but since you just sold the stock, we'll let you get that back as a tax credit in future tax years. it might have to be spread out over a number of years. There's some limitations on it. Speak with a tax professional. This is not the video to dive into the specifics. Now, there are some strategies to avoid or reduce the impact of the alternative minimum tax. We just talked about one earlier, which is if you exercise the stock in 1 year and you sell that stock in the same calendar year, you don't need to worry about the alternative minimum tax because that bargain element is directly offset when you sell the stock. The problem we run into is when those transactions happen in 2 different years. If you are leaning towards doing a disqualifying disposition, it's oftentimes advisable that you exercise the stock at the beginning of the calendar year, and that way you have the entire calendar year before you have to officially decide whether or not you're going to sell the stock. Obviously, if the stock goes down, you'll take a loss, but if the stock is up, you might work with your tax professional and run side-by-side tax calculations to see how much of your stock is going to directly impact your AMT. If, for example, you exercising that stock doesn't actually push your AMT over what you otherwise would have paid, well, maybe you can hold on to that stock because that bargain element you generated previously didn't affect your alternative minimum tax. On the other hand, if you and your tax professional are running some projections and it appears as if that bargain element that you recognized earlier in the calendar year will push your AMT over the typical accounting methods, it might be in your best interest to sell the stock in that same year. The calculation as to whether or not AMT will be higher than your typical accounting method, that's called the AMT crossover point. It's at what point does the AMT cross over the threshold that your typical accounting method sets. This may require you to spread out when you exercise your options over a number of years, because too much exercising in 1 year will create too large of bargain element that will push your AMT up pretty high. So it might make sense to exercise a little bit each year rather than all at once to save you some taxes throughout the length of your exercising. And obviously, yes, that means a huge bargain element might not turn into that much of a bargain at all. One strategy to look at is exercising your options as soon as possible. That could make sense if the stock price and the exercise price are pretty close together. Maybe you could exercise a ton of options in 1 year and still not push you over that AMT threshold because the bargain element is so small it's almost negligible. That's great because you get access to the stock. You can start that 1 year holding period to ideally try to achieve a qualifying disposition without having AMT really mess you up. On the other hand, if there's a huge bargain element, we'll need to go back to the strategy of exercising in smaller chunks year after year rather than exercising all of them at once. It really just depends on how fast the stock is growing since the day it was granted to you. Another strategy to employ could be selling out of stock that you previously exercised in the calendar year that you're exercising new options. So exercising new options would create a bargain element that you'll need to factor into AMT, but then selling the stock will back you further out of the previously paid AMT. And so that could do sort of an offset method where, similar to capital gains and capital losses, you might be able to wash the two away to where your AMT goes up and then it comes back down as a result of selling previously exercised stock. What are some best practices here? I would say don't let the tax tail wag the financial planning dog. I've run into too many folks after they've blown themselves up, and one of the biggest reasons I see for that are folks that are too over-concentrated in one particular stock. Rarely do I see somebody blow themselves up financially when the basic blocking and tackling of their finances has been done, where they have an emergency fund, they're saving into their retirement accounts, and they're super well diversified with their investments. Most of the time, people blow themselves up when they're too over-concentrated in one particular stock. And so if the math recommends diversifying your company stock, I wouldn't try to get cute with a bunch of minute tax planning strategies, when in reality, it's probably in your best interest just to cut bait, sell the stock, and diversify. Yes, you'll save a couple extra bucks in taxes, presumably if you hold out long enough for a qualifying disposition, but you also might not. If the bargain element's too high, you might pay a ton in alternative minimum tax liability. Obviously, it goes without saying, coming up with a plan ahead of time is in your best interest, rather than reactively deciding what to do with the stock in the middle of either an opportunity to exercise or a highly appreciated stock and it's an opportunity to sell. Don't get caught off guard with the alternative minimum tax calculations. I'd highly recommend seeking out the guidance of a professional tax advisor to help you run those side-by-side comparisons to help influence you to make some good decisions. In a perfect world, you'd have your financial planner and your tax professional speaking in symphony. That way, both your long-term financial plan and long-term financial success can be taken into account, as well as the tax consequences of making decisions with your stock so that ultimately they can present a unified front in giving you the best guidance and advice on what to do with your incentive stock options. So what are your calls to action? Number one, find out if you're eligible to receive incentive stock options. Number two, if you are, find out the vesting period so that you know how long you have until you need to come up with a plan of action on what to do. And then number three, run those side-by-side comparisons on the typical accounting method versus the alternative minimum tax method. So that'll help influence you to know how much of what you can do to avoid paying taxes if you don't have to. So hopefully that was helpful. If you have questions, drop them in the chat below, send me an email. We'll get you squared away. Have a great rest of your day. We'll talk to you later. Bye.